All right, welcome to Talk Tickers. Today, we're diving into something pretty interesting, Navan's very first earnings report since going public, and boy, did it cause a stir. The numbers came out, the stock took a dive, and honestly, it left a lot of people just scratching their heads. So let's get right into it and figure out what's going on.
So here's the core of the mystery, right up front. On one hand, you have the results. Navan posted a revenue beat of over 7%. I mean, for your first ever report as a public company, that's exactly what you want to see, right? But then, look at the reaction. The stock gets hammered, dropping almost 12% the next day. A beat, and then a drop. That disconnect, well, that's what this is all about.
So, what gives? What on earth did the market see that all those positive headlines completely missed? That's the big question, and that's exactly what we're going to unpack right now.
Okay, so to really get why the market freaked out, we first have to look at the good stuff. We've got to build the bull case because, honestly, on the surface, this was a really strong quarter. There were a ton of positive signs that should have made investors happy.
And it all starts with a top-line number. We're talking $195 million in revenue for the quarter. Now, you have to remember, Wall Street was only expecting around $182 million, so they didn't just beat it, they sailed right past it. For a company that just went public, a beat like that, well, that's a huge statement to make right out of the gate.
And when you look under the hood, the engine looks even stronger. Yeah, revenue growth was solid, up 29% from last year. But check this out. Gross booking volume, or GBV, was up a whopping 40%. Now, why does that matter? Well, GBV is a leading indicator. It tells you how much business is coming down the pipe. It means customers are booking travel way faster than Navan is actually counting it as revenue. That signals a really strong demand pipeline.
And believe me, the good news didn't stop there. Their non-GAAP earnings per share actually came in positive at 14 cents. Think about that. A year ago, they were losing 31 cents a share. That's a massive turnaround. They also hit a record non-GAAP gross margin of 74% and a really healthy 13% operating margin. Oh, and on top of all that, they're landing huge customers. A major European company, Visa, Frasers Group. I mean, this is the picture of a company that is absolutely firing on all cylinders.
So you're probably thinking what I was thinking. If everything looks so good, why in the world did the stock get crushed? Well, that brings us to the other side of the coin, the bear case. This is where you have to start reading between the lines of the report.
And bam, here it is. This number right here is a huge part of the story. While those adjusted non-GAAP numbers were looking all shiny and positive, the official number, the GAAP net loss, was a staggering $225.4 million. That's a huge loss. And you have to remember, in this market, investors are getting really tired of growth companies that don't make actual money. This number was a massive red flag that basically wiped out all the goodwill from those other metrics.
But it wasn't just about the losses they already had. No, the real poison pill, the thing that really spooked investors, was what they said about the future. Their guidance for the next quarter told a completely different story from the one we just heard.
I mean, just look at this reversal. In the quarter they just reported, Q3, they delivered a positive 13% non-GAAP operating margin. That's great. But for the next quarter, Q4, they're guiding to a loss of around 9%. That is a shocking 22-point swing in profitability in just 3 months. If there's one thing the market absolutely hates, it's uncertainty. And a sudden drop like that, it sent investors running for the exits, plain and simple.
And just when you thought it couldn't get any worse, there was this, a major leadership shakeup. They announced that their CFO, Amy Butt, was leaving. Now keep in mind, she just joined the company earlier this year and was the one who guided them through their big IPO just a few months ago. When a CFO leaves that quickly after taking a company public, it's a classic red flag for Wall Street. It screams instability and execution risk, and just adds another thick layer of doubt onto everything.
So you can imagine the earnings call was a little tense. Management clearly had to do some serious damage control, and their strategy was pretty clear. Pivot. Pivot away from the ugly guidance for next quarter and get everyone focused on their big long-term vision. And that vision is centered on one thing: AI. The CEO, Ariel Cohen, really hammered this point home. He talked a lot about their AI support agent, Ava, and made this incredible claim that it's already handling over half of all their user interactions, with satisfaction scores as good as a human. The message they were trying to send was pretty simple. Hey, don't worry about this one bad quarter of guidance. Our AI is the future. It's what's going to drive our costs down and our margins up.
They also spent time talking about something called NDC to really drive home their tech advantage.
Now, without getting too in the weeds, just think of NDC as a modern, direct data connection to the airlines. It lets them skip over all the old, clunky systems, which means they can get better prices and offer more options to their customers. So their whole argument to investors is that this tech moat, plus their AI, is what makes them totally different from all the old-school competition.
All right, so there you have it. You've got this powerful bull case, driven by incredible growth, clashing head-on with a scary bear case filled with profitability worries and leadership risk. So where does that leave us for the next earnings call? It's time for our verdict.
Looking ahead to Q4, here's what we're predicting. On revenue, we think they'll probably land right in the middle of their guidance, so let's call it around $162 million. But honestly, nobody's going to be looking at the revenue. The real number to watch is that operating margin. They guided to -9%. We think, with all the money they're spending and the disruption from the CFO leaving, they might miss that slightly. We're penciling in something closer to -9.5%. Trust me, all eyes are going to be on that bottom line.
And all of that brings us to our final rating for Navan, market perform. Look, you can't ignore that explosive 40% growth in bookings. That proves people love their product. But you also can't ignore the other side, the massive gap losses, the really weak guidance, and that leadership uncertainty. It's a classic standoff. So until Navan can prove to the market that it can deliver both growth and a believable path to making actual money, we think this stock is probably just going to tread water.
And of course, just a reminder, this is not financial advice.